Hi, my name is Peter John B. Morales, and together with my groupmates, Shanley Irish Agueme, Marvin de la Vega, and Jamel Tropia, we are the Group 7, and we are going to discuss all about supply and demand capital investment problems. The funding environment for HTSFs has increasingly, since the early 1980s, been characterized by both supply and demand side problems. From the perspective of the demand side, when HTSF entrepreneurs have sought investment support for their new or established business, there have been instances where apparently deserving firms with viable new product or service ideas do not obtain the capital they need from venture capitalists. It's according to Harriot in 2005, leading to frequent complaints that impressive applications for support have been rejected after scant consideration, according to Mason in 1996, Cruikshank in 2000, and Fraser in 2004. Moreover, the establishment of quasi-public venture capital funds, for example, the regional venture capital funds in the United Kingdom, charged with the aim of being less risk-averse and seeking to fill the possible fundable gap, has frequently resulted in these funds being underspent in terms of actual regional investments, according to Harriot in 2005. Often, failed applicants for support from these regional funds have, again, complained the good proposal for the advancement of funds fell on deaf ears. The two supply and demand sides of the HTSF investment equation will be discussed in more details by the other reporters.
Hi ma'am, hi classmates. I am Jamel Tropia and today I'm going to report about the demand side. Demand side economics. Demand side economics holds that giving tax breaks to the rich does not improve the economy. Government works projects and other government efforts that create jobs are the focus of demand side economics. By expanding job prospects through government initiatives, more customers may feel more comfortable spending more, resulting in increased economic growth. In short, demand-side economics focuses on helping consumers maximize their income by reducing taxes to spend more on goods and services. Demand-side economics consists of two types of policies. The first one is monetary policy. The government creates monetary policies to reduce interest rates. This makes it easier for consumers to pay off debts and encourages them to make major purchases on things like cars or homes. So, monetary policy refers to central bank activities that are directed toward influencing the quantity of money and credit in an economy. The next policy is fiscal policy. The government creates fiscal policies to rebalance tax rates so that consumers receive a lower tax rate than more wealthy individuals or businesses. So fiscal policy refers to the government's decisions about taxation and spending. So, what is demand? Demand is the quantity of a good that consumers are willing and able to purchase at various price during a given period of time. So, tumutukoy sa dami ng produkto at serbisyong nais at kayang bilhin at sa iba't ibang presyo sa takdang panahon. So, yan ang demand. The law of demand. Consumers buy more goods when its price decreases and less when its price increases. So in short, when price goes up, demand goes down, and when price goes down, demand goes up. So So, vice versa yun. Next is factors of demand. Number one is changes in income. So, pag tumaas ang income consumers buy more. When goes down, consumers buy less. Next is prices or availability of substitute. A substitute is a good that can be used in place of another. For example, is Starbucks coffee and Dunkin' Donuts coffee. So dito, price varies siya. Next factors is prices or availability of complementary goods. Complementary goods are things that are often sold or used together. For example, PS5 or Nutella are the complementary goods. Changes in number of buyers. So, more people or more buyers, more sales. So, the next topic will be all about the supply side, and it will be discussed by Marvin de la Vega. Thank you.
Good day, I am Marvin de la Vega and I will discuss the supply capital investment problems. So what is supply side? Supply side policies for innovation in firms aim at increasing firms' incentives to invest in innovation by reducing costs. They include direct funding of firms, R&D, fiscal measures, the dev and raise rate sharing schemes, and technology extension services. What are the supply side policy instruments for HTSFs? Number one, direct funding of firms' R&D. This includes grants, subsidies, subsidized loans, and equity financing. For fiscal measures, fiscal incentives for innovation in firms consist in a favorable tax treatment to R&D expenditure and may take the form of tax credits, accelerated depreciation of R&D equipment, tax holidays, import tariff exemptions on equipment and other research inputs, and exemptions on social taxes for R&D employees. For dev and risk sharing schemes, these instruments aim at reducing the risk faced by lenders or investors when financing firms' innovations and favoring thereby the provision of financing to viable businesses that will be credit constrained otherwise. For technology extension services, these services are provided by government-funded programs to HTSFs. The main aim is not to develop new technology, but rather to expand the diffusion and adoption of already existing technology, and to contribute to increasing the absorptive capacity of targeted firms. So what investors think about this? Well, there are some supply side problems. The issues of growth potential is particularly critical to HTSFs. A major problem for any firm seeking financial support by raising equity capital is convincing investors that the product under development will sell. In cases like this, where the new product is in a market where there are many current competitors, as noted above, benchmarking the new product in terms of specification and price can be relatively easily achieved. Although competition will be strong, however, when the product is leading edge and there's no competitor against which to benchmark, and no sales will be achieved for 5 years or more, proof of the growth potential of a proposed new HTSF product to a venture capitalist is almost impossible. Potential funders of a proposed development might also refuse funding, not because they are convinced that the applicant will not moderately or spectacularly succeed, but because they cannot reduce their risk by obtaining good evidence of a market potential. However, it is often the product with greatest potential that have no current market performance evidence because they are truly groundbreaking, unlikely to become highly disruptive, successful and profitable, like Amazon, Google, and Facebook. So, in conclusion, firms often remain unfunded, not because they do not have a growth potential or assets, but because they cannot obtain the front end front end funding they need to become to be a viable business venture by crossing the valley of debt caused by high initial research and development costs during the product development. So that's my part for the supply side. Thank you and good day.
Closing the funding gap when it occurs. Clearly, any government development agency seeking to enhance the growth of HTSFs within its sphere of responsibility must seek to increase the attractiveness of private sector capital on offer to HTSF founders. In order to maximize the performance of all HTSFs with growth potential within a national economy, it is clearly essential that no HTSFs with proposals for external funding to support viable programs of innovation and growth are denied the investment capital they need and are given the best chance of prosperity. This is an area where national and regional development agencies might seek to take special actions in order to help HTSFs by seeking to repair any failures in the private capital markets for HTSF loan and investment funding, particularly in circumstances where HTSF with good growth potential are unable to obtain the funding they need for expansion, for which there is substantial anecdotal evidence. In this context, Figure 7.3 assists in our understanding of the problem of extending investment into unfunded yet viable HTSFs that seek external financial support. Clearly, there must always be a percentage of new business ventures that, although keen to raise external capital, would never be eligible for external investment support due to the poor current and likely failure state of their business. From the perspective of loan and equity funding, these enterprises may be as many as 60% of any given total as predicted in Figure 7.3, although all the percentage included are necessarily national and are also only used here in order to make the key point about potential funding gap. Conversely, a smaller percentage of new business ideas are immediately fundable by the private sector on the basis of the great strength of a new idea or new business plan. Although 10% of Figure 7.3 might be slightly inaccurate, most studies on this subject suggest that the portion would not be greater than 20%, according to Murray and Lott 1995. However, a further 20% of SMEs are termed probably unfundable for a variety of reasons related to management competencies, project viability, market potential, and other factors. The key area of Figure 7.3 is perhaps a small say, no more than 10% margin of potential investment cap recipients who currently do not receive help but are probably fundable. The problem for the government agencies charged with increasing the level of formation of firms, innovation, and growth in the national economy over and above that which would otherwise occur through the private sector is to extend investment into key area of probably fundable firms. This would achieve in the case of Figure 7.3 by doubling the percentage of firms receiving support from 10% to 20%. Funding the critical area of Figure 7.3 involves an essential balancing of the needs for profit with those of national industrial development. To put simply from a hard-headed business viewpoint, unassisted venture capitalist deal-makers would be unlikely to venture into this critical area in order to preserve their normal required return on investment, which would be likely to decrease if more risk was taken. However, from an additionality perspective, governments may seek to assist these only marginally more risky firms and ensure they receive the venture capital or other forms of finance they need in the interests of long-term additional industrial growth, given that, as noted above, anecdotal evidence suggests that HTSFs with good business proposal do not currently receive funding, according to Harriet 2005. These observations lead to some further comments on the way forward. There has been a growing consensus that public-private partnerships of various kinds are the way forward regarding the financial HTSFs. In the United Kingdom, the Enterprise Capital Funds, or ECS, are one example of how, based on the experiences of agencies in the United States and elsewhere, the UK government seeks to trigger the investment of private capital through public financial support. Specifically, public sector capital is designed to help encourage private sector funding into the probably fundable critical area of Figure 7.3 in order to support currently unfinanced HTSF growth. Smart and Spur grants have been another possible source of capital for HTSFs, now replaced since 2005 in England by the Grant for Research and Development Scheme. However, according to Ross 2000, a major problem with any grant funding is that, notwithstanding the fact that many HTSF will not be successful in obtaining aid for firms that do not receive funding, it is a lump sum with no guarantee of medium to long-term commitment. While these grants have often triggered further private sector support, and according to Smallbone and others 2000, Oki 2003a, there is no certainty of medium-term financial security. Other more local public sector initiatives involving grants, the proof of concept grant scheme, are also aimed at encouraging private sector investment beyond what is currently achieved into the 10% critical area of Figure 7.3. However, a similar problem with this type of grant is again that there is usually little medium-term commitment by the grantor or lender to the financial stability of the investee firm concerned.